Hello and welcome back to the show. So I'm super excited today for our episode because I'm sitting here with my guest, Arn Senendella, who is really a legend in the real estate industry. If you look at his resume, so Arn built a successful real estate brokerage on the residential real estate side before he became a real estate investor, and they worked with other investors to help them get into their investment properties. So Arn has a lot of experience in both the residential side of real estate investing and sales, as well as now the multifamily side of real estate investing. It's built his portfolio up to many real estate units in his syndication and is helping other investors, coaching them, mentoring them, helping them become investors and being better at what they do as well. So in today's episode, we're going to be talking about how to increase your sales as a real estate agent through investing and working with investors, as well as how to transition from being in residential real estate to multifamily as well. So it's going to be super exciting. But Arn, man, thank you for being here and welcome to the show.
Yes, Kobe, thanks for inviting me on your show. It's a pleasure to meet you and looking forward to have a nice conversation that will hopefully help your listeners accomplish their goals and their dreams about real estate investing as well as brokerage. So looking forward to the chat.
Yeah, for sure. So you have an experience in both sides, right? So you have experience on the brokerage side, on the residential investing side, and also on the commercial multifamily investing side as well. So I think it's very interesting to have that conversation as well to see how those experiences tie in and how they kind of relate to each other as well. But before we dig into that, I would love for you to be able to share a little bit about just your journey through real estate. Like I said, you've done a lot. So, how did one thing lead to another, and where you get to where you are today now?
Yeah, so I'd say I grew up in the San Francisco Bay Area and had the good fortune to kind of be in Santa Clara County while it transitioned from basically an agricultural county. Libby Can Food Company was the biggest employer in Santa Clara County way back when I was a kid. And of course, it's now better known as Silicon Valley. And so obviously, it was a great place to sell real estate, a great place to invest in real estate. And of course, we're seeing some of those same things in Texas now, another kind of booming market. So it's interesting to watch how historical patterns can repeat themselves in different locations. Um, so I was a typical, I think, middle income American kid. Parents said, do well in school, work hard in school, get a college degree, and go to work and have a great job. And so I kind of did all that and ended up with a master's degree in physical chemistry of all things from the University of Michigan. But I wanted to return to the Bay Area, and I didn't see my life unfolding in the academic world. My father had a residential brokerage business in Menlo Park, and he said, "Come on out, get your license, and I'll put you to work." I think I was about 23 years old, had really no idea what the business was about, but wanted to return to my home in the San Francisco Bay Area. And March 1978, got my license. And as I said, I feel blessed to sell houses in one of the best residential markets in the world, of course. And uh, my father was also, in addition to a broker, an investor. And kind of what he taught me early on, and I think this maybe will tie our whole conversation together, was he talked about using the income real estate brokerage can create. And real estate brokerage can be a very lucrative profession. It's not easy, but if you hustle, you can make good income. And what he said was you use that income to create capital that you then invest in real estate to kind of create a long-term wealth and passive income So the notion is use the brokerage to create the income that then creates the capital that you then invest and put to work for you. And that's really the way you kind of create long-term wealth and financial freedom is put the money you earn to work for you in good investments. And it doesn't have to be all real estate. I love real estate, but I own stocks too. So I do believe in a diversified portfolio. Um, so uh, followed my father's kind of footsteps, and as I started making more money and growing my brokerage business, started buying single family rentals in the San Francisco Bay Area. And just to level set everybody's expectations, this was back in the 1980s where the prices may have been high, but they're certainly not as high as they are now. And actually, you could still buy single family homes that made some kind of sense for rent. Today, 2024, not so sure that's the case in the San Francisco Bay Area. So I slowly started buying rental homes. And I started like many investors did. You buy your first home and you move into it. And it's a big day, it's a big kind of stepping stone. And we lived there for about 5 or 6 years. It was just a townhouse kind of in a rough section of town, right up against Bayshore Freeway, Highway 101. But 4 or 5 years later, we were making a little bit more money and kind of moved to a single family house in a little better neighborhood. And we kept our first home as a rental. So I think that's a very typical pattern for people to start their rental portfolio kind of one house at a time. And had the good fortune to start investing in Austin, Texas in the early 2000s. And of course, we all know what's happened in the Austin market. So I continued to do that for basically 35 years. My entire adult life has been in real estate. And then in 2014, Laura and I were ready for something different, kind of life transition, wouldn't say so much retirement. And we moved to all places, Greenville, South Carolina. So we moved clear across the country, totally different world. Continued the single family investing. That's kind of what I knew. That's what I did. And then right about the time COVID hit, uh, a young investor friend of mine here in Greenville, South Carolina, and I had a conversation. He turned me on to a podcast about multifamily investing. And uh, things were kind of shutting down here. Not as bad as it was in California, let's say, but the gyms closed. And so I took to my bike and rode up and down this trail for hours at a time and consumed podcasts about multifamily investing. So basically, about 4.5 years ago, I started the transition, both my business from single family rentals into multifamily and then syndication. And that's kind of the story in a nutshell. And we can talk more.
Yeah, so I think it's really interesting that, your transition into multifamily came, after you had a ton of years of experience in the single family space, right? Because there's a lot of investors who, I guess they make that transition, maybe 5, 10 years as they are investing in single family, and then they, for whatever reason, they transition into multifamily. So you've already had, basically a system built out, building out your single family portfolio, and then you transitioned into multifamily after, really being very familiar with one in, kind of sector of investing. So
Mhm.
what was that like? So, being somebody who had that much experience with one, you will feel that, you're probably more comfortable, in that one sector versus moving into this new sector of multifamily and syndication.
Yeah, that's a good question. And to be honest, part of it was, I don't know if bored would be the right word, but I kind of been there, done that. And I think, and I'm older. Uh, and I think as one keeps learning and developing new skills and new interests, that helps one kind of keep young and active and involved. And so I had done the single family investing for many years, decades. It had done well for me. The properties appreciated in value, increasing my net worth. And I would never talk anybody out of being a single family investor. It's a tried and true way to create wealth. And if that's what somebody wants to do, uh, I'm 100% behind them. It's a great way to go about it. And folks in the real estate industry, they have kind of a competitive advantage. So I would encourage the agents and brokers who are listening, if you're not investing, really start thinking about investing and creating that income that you don't have to be constantly on call about. Put that money to work for you. So one, uh, I just was at a point in life I wanted to do something different. It was still in residential real estate, so it wasn't a total 180-degree turn. It's just kind of a variation on a theme. And the other part of it is we all have certain skills, certain abilities. We have things we like to do, and we have things that we really don't like to do, maybe things we're not that good at. And so single family investing tends to be a little bit more of a solitary experience. You have your properties. Yes, you have a broker, you have an insurance agent, maybe you have a property manager, but it's more kind of an activity pursued by an individual or a couple, let's say, for lack of a better term. Where with multifamily, and as you get into these bigger assets, it's more of a team effort. And so typically, most of the best multifamily investment groups have a team of 3 or 4 individuals, all who have unique skill sets and personalities. And so by moving to multifamily, I was able to find partners who were better at certain aspects of real estate than I was. Uh, I kind of enjoy hunting the deal and finding the property and talking to investors. The day-to-day operation, maybe not quite my cup of tea, and it's not what I excelled at. I was fine at it. I managed most of my properties, but I can't say I was an exceptional talent in the management of the property. I'm a smart guy, but I'm not really a spreadsheet guy. I'm not a numbers cruncher. I love this. I don't know if your audience can see it, but it's an HP 12C calculator that's now about 40 years old. So that's how I do my deals, and now we have uh, spreadsheets and models and all of that. So uh, through multifamily investing, I've been able to partner with people who have skills that I don't, and therefore we've been able to complete a team that has all the bases covered and is kind of exceptional in each area. Plus, I just enjoy these people. They're friends. We love working together. And so it increases the enjoyment of investing in real estate. And then I think the final point is um, I think most people are aware we have a housing affordability problem in this country. And the most affordable housing available to Americans is either going to be apartments or perhaps mobile homes. And so I felt, number one, investing in an asset class that is always going to have strong demand. We're never going to have enough affordable housing. I think there's always going to be a limit, but the demand is always going to be there. So I think investing in an asset class where there's strong demand is good. And then two, um, by being a conscientious operator and taking pride in your properties, you're also contributing to the community because people work hard. Rent everywhere is expensive. And in return for paying rent, they deserve a decent place to live for them and their family where everything works, it's safe. And so by investing in multifamily, I can do a little bit to contribute to providing some decent housing for people who need it. So uh, there's kind of a community aspect about it that I like also.
Yeah, that's actually very insightful that you think about it in that way as well. Because when it comes to investing, I think people miss that point a little bit sometimes when it comes to actually delivering, a service or a product that is, worth paying for, right? For your tenants. That is something that people can really be proud of as far as, hey, this is the place that I live, and the people who own this place, they take care of me, and I would they'll continue living here as well. So that actually makes the turnover rate a lot lower too. So I like the way that you think in that sense.
Bingo, 100%. I'm not representing myself as Mother Teresa. I'm an investor. I want to do well for my investors, but I want to treat everybody with respect and consideration. And as you note, one of the biggest for property owners is vacancy and turnover, because typically when you get a vacant unit, you got to go in and probably spend a couple thousand minimum just to paint and clean. And so as an investor, if you can minimize turnover, you're increasing your bottom line. And the other thing is if you create a nice environment for people to live, you're going to attract better tenants, going to be less trouble, lower maintenance, fewer issues. So it's a win-win situation. Uh, Somebody likes living in an apartment building you own, they're going to tell their friends, and they're going to have a similar nice tenant move in. So there's a business aspect to it, but also doing the right thing pays off for investors. So it's a win-win.
Yeah, exactly. It's, when you treat other people, better, you treat them with respect, then it's actually better for you and your business as well. So it
Yes.
absolutely benefits the operators as well as the investors to actually provide something that is that is respectable in a sense. So that's
Yes.
very valuable there. So one of the other things you mentioned as far as the aspect of multifamily investing specifically is that you're able to do it with a team of people, right? Putting together the partners, raising money for syndication, and then also operating on the properties as well. So what does that look like as far as actually finding people to partner together with you in order to, start that journey of investing in multifamily properties?
Yeah. So, yes, that's a great question. So, first of all, I would say it's kind of like dating. You don't get married on the first date, and don't partner with somebody you met 2 days ago. So, I think when you're finding partners, um, you have to take your time. You got to get to know that person, both about their investing philosophy and approach, uh, and also just about their character integrity and kind of how they go about living in the world. So um, the partnerships are very important. There's nothing worse than being in a bad partnership. So take your time finding the right people. And to share my personal experience, I have two primary partners. One is a guy named Brian, and he takes care of the day-to-day operation of our assets. He was trained as a master plumber. He knows his way around construction sites, has a property management company here in Greenville now, manages about 500 houses. And when I moved to Greenville 2014, shortly thereafter, I bought a duplex a block away from me. It was kind of a wholesale deal. And I ended up meeting Brian through that process. He was managing the property and so forth. So uh, we became friends. We developed a relationship over time. I started turning over my single family rentals to him to manage, and we developed a friendship. I saw that he was a very effective property manager, and after I turned over my single families to him, I said to myself, I should have done this 3 years ago because it takes this load off my plate. So we developed a relationship over time. And as I started to move to multifamily, uh, and let me just back up. Uh, when you handle other people's money, when you handle other investors' money, there's even a higher level of responsibility, right? If you're investing your own money, we're adults. Uh, we're going to win and lose by the decisions we make, and that's how life should be. When you're working with other people's money, there's even a higher level of responsibility. And as I started to move to multifamily and started to look to buy apartment buildings in the Greenville market, I kind of understood I probably wasn't the best guy to operate the asset. And so I was hesitant to take that leap until I knew I had somebody on board that could professionally manage that asset. And so literally, it took me about 12 to 18 months of talking to Brian about multifamily, educating him about multifamily. We probably looked at 3 or 4 other deals. Nothing quite was right. Finally, after about 18 months, we found a property that we both liked, and we took that leap. And bought it through syndication, and it's done great. And now that he's been exposed to multifamily, he really loves it because you can think about it. If you own a 40-unit apartment building, you have 40 little sources of income, and they're all right in this one little area, which is a lot easier to manage than 40 houses spread out across your city or county, So there's a value to having all of these income producing assets in one space. And the other thing that's great is there's generally only 1 or 2 floor plans. So kind of once you remodel one, you know how much counter you need, you know what sink to order, you know what toilet, where when you remodel or upgrade, flip 40 houses, each house is different and you kind of have to reinvent the wheel as you go. So Brian and I started and had a successful 3 or 4 transactions. And I would attend various multifamily conferences. Uh, I usually do 2 or 3 a year. So for aspiring investors, brokers, I would encourage you to attend conferences, network with other investors, kind of see what they're doing. You may find a partner, you may find an opportunity. Um, so on one of these conferences, the best ever conference that usually takes place in spring, it was COVID, so it was an online conference, and I met an individual named Dan, uh, who was also from the San Francisco Bay Area and relocated to the Carolinas like I did. So we had some kind of connection. And he lives about 3 hours from Greenville. So over the years, he started investing with us and liked what we were doing. And his career was as a CFO. He was a number cruncher, financial accounting. Brian and I were real estate guys. We could handle the accounting, but we didn't do it very eloquently. Uh, and I knew Dan was getting to the point, he's now early 50s, where he wanted to leave his W-2, go full time to real estate. So as he started investing with us, We then started to bring him into the general partnership team, the active team. And again, this was an individual I knew 3 or 4 years. We had some business dealings together. We enjoyed working with each other. We had similar views about investing, and we brought him in. So I'd say in my case, it all happened organically and naturally. Uh, and it happened in the right way. So that's how the team's kind of been built. I think we have a complete team now. But of course, as our business evolves, we may find another need and have to find another partner. And there's a great book, you probably know of it or have read it, Who Not How. So it's not so much maybe learning how to do a particular skill in today's world. What it's more about is finding that person, that who, that has that skill set that you need to take your business further.
Wow. Yeah, that's really good. As far as,
Yeah.
investing in with a team of people, right? That is exactly what that philosophy plays into is, it's very difficult to try to learn all of these skill sets and be very good at them as an individual, just by yourself. But once you have a team of people who each specialize in what they do really well, then you can accomplish a lot more. And that's how you're able to move into larger asset classes like 40, 50, even 100 unit
Correct.
apartment complexes and syndications as well. So yeah, so one of the other things that you had brought up as far as picking the partners that you want to work with is, do they have a similar philosophy of investing, as you, right? Does everybody kind of think pretty much not the exact same way, but pretty much everybody think, kind of in the same direction? So, I know you have a little bit more unique philosophy when it comes to investing. So I think a lot of investors, when they think of investing, they think of cash flow. They think of how they can get their best, the most amount of cash flow. And that, I believe, you have a different philosophy when it comes to investing. So I'd love for you to be able to share that, and why that is, and what are other investors missing that they're not seeing from what you've seen in your experience in investing for the amount of time that you have.
Well, Kobe, I appreciate that question. And so, yes, many investors believe cash flow is king, and it's the most important thing to evaluate when you're looking at investments. Um, in my mind, I've always invested for equity growth and increasing net worth. And of course, and like many discussions, it's often more both and than either or. And the truth is, if you increase cash flow, that means you've increased NOI, which means you've increased value. So they're not diametrically opposed. Um, and what I'd also say, depending where one is at in their stage of life, in their career, family, their age, I think that also impacts investing approach. And what I mean by that is um, most people who are able to invest in real estate are making pretty good incomes, right? Because at some point you need to live on less than you make. And that delta there then becomes investable capital that you can put in the stock market, you could put in Bitcoin, you could put in real estate, you could buy wine, you could do whatever you want with it. The key is to get it invested and getting it working for you. So uh, I would say in most cases, investors have an income that supports their lifestyle. And I would say what they're more looking at is what's their life going to be like in 10 and 15 years? And are they going to be able to quit their W-2? Are they going to be able to be work optional? Are they maybe going to continue in their field, but not in such a high pressure, high demanding job. I talked to an investor today who works, he's kind of a designer builder and he works on airport projects and it's well paid, but he'd actually like to design boutique hotels. And so through real estate investing, he may be able to leave that high pay airport design job and kind of do what his real passion is. So as people are early in their working career, moving up the earnings thing towards their peak earning years, I'd say in most cases, they have enough income to support their lifestyle. So to me, in my mind, the real goal of real estate investing is not to put money in my pocket today, but rather how do I make my nest egg the maximum size 10 to 15 years from now, which means equity growth. And to put it in perspective, if somebody had $2 million of investable assets and somebody had $5 million of investable assets, who ultimately could create the most cash flow? I think the answer is pretty obvious. The person who has 5 million of chips to put in can. And then I would say, as one evolves through life and perhaps is getting older, maybe looking for towards retirement, though of course the definition of retirement is changing as we speak because I'm going to live till 90. My parents lived to the late 80s, and so from 65 to 90, what are people going to do? I think you still have to do something productive, but it can be fun. I mean, for me, real estate's fun. I'm productive. I enjoy helping people. I'm being compensated. So maybe as one ends or nears the end of their traditional working career, maybe then the focus more turns towards cash flow as opposed to growing equity and net worth. So I've always invested to increase equity, increase net worth. The other thing I would say, at a certain point of net worth, nobody worries about cash flow. No one worries about paying the bills because at a certain level, there's enough income coming in, whether it's interest in a money market account or dividends from stock or rental income from real estate. There's enough income coming in that the cash flow side of it no longer becomes kind of an equation. I think the other thing I would say is, in my experience, generally the more desirable areas appreciate more than maybe the less desirable areas, though the apparent cash flow in the less desirable areas may look a little higher. Or another way to say it is, you're going to pay a premium for an A location over a C location. You're going to pay a premium, and that premium usually comes at the cost of lower cash flow. But then the question becomes, do you get the bigger payout at the end? Because the Class A property, the A location is probably going to appreciate more. Uh, and so uh, I think sometimes investors can get brought into a deal that maybe looks good on paper from a cash flow point of view, but actually executing that plan and meeting pro forma is a little tougher the rougher the property goes. So that's just my experience.
Yeah. So you're saying that people shouldn't be sacrificing the equity appreciation for cash flow, especially if they're a little bit earlier on in their investing careers, because, the more, you know, equity appreciation, the higher your net worth is, then the higher your cash flow is going to be as well. eventually. So that's it's a more long-term approach to investing, which is really the correct approach if you are investing, especially in real estate.
Yeah, well, yes, that would be my opinion. So you know, when the real estate markets get hot from time to time, and I kind of generally see 10-year cycles where you have 5, 6, 7 years of up, maybe a year or two of retrenchment, though the downstroke is never nearly as large as the upstroke. I mean, if you look at it over 40 years, uh, the curve is going up. It goes up, drops, flattens, goes up again. And I would say for investors, uh, under what scenario can anybody see the cost of housing, either to buy or to rent, is going to be less 10 years from now than it is today? I, 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 I don't see any scenario that that's going to happen. So I think if you take a long-term perspective, you're going to win. Uh, and, in the multifamily space, things got a little crazy back in 2022, and people are paying the price now. And if you go back to 2006, 7, and 8, similar things happen in the residential market. But I would say to you, are houses more valuable today than they were in 2008? I would say yes. Uh, and it's very interesting because the same factors played in both. For those who lived through the Great Recession, subprime crisis, it kind of developed from low money or no money down loans, adjustable rate mortgages, and also no documentation loans, where basically borrowers didn't have to prove income. In the multifamily space, we have similar loan products. They're called different names. So in multifamily, it was floating rate bridge debt, which is exactly the same as an adjustable rate home mortgage. Uh, with the floating rate bridge debt, you were able to obtain a higher loan to value than you could with fixed rate debt on loans. And then the other thing, the floating rate bridge debt was often based on what the income of the property was going to be 2 years from now. It wasn't based on current performance, it was based on projected performance, which is similar to phantom income that may have been put down on no doc loans. So it's just interesting that we've had similar events, in my opinion, based on similar causes. But long term, I'm still a buyer. And I would say for investors, I think the other thing that maybe I'm a little different in is I'll call myself an old school fundamental investor. My dad taught me. My dad lived through the Depression in the late 20s as a young man, so that tends to shape one's philosophy. And so I would say, if you buy real estate, get fixed rate debt, don't over leverage the property, have ample cash reserves, because there's going to be a time Murphy's Law strikes and your HVAC unit blows up or rents drop a little or whatever. So fixed rate debt, low leverage, ample cash reserves, and know how to operate the property. And if you do that, you're going to be able to own that property. The way I describe it is, make sure the property is self-supporting. Because if the property's self-supporting, even if there's economic turbulence and values go down, you don't care because you don't have to sell. You just keep owning it. And eventually it's going to be worth more. Eventually you're going to win. So the way people have gotten hurt in real estate is when they get overextended can't really afford the property, some mishap occurs, and now they're forced to sell in a down market. So as long as you set it up properly, you can ride out the bad times, you're going to benefit on the good times. So um, for a while there, people could flip apartment buildings, as you know, Kobe. It was happening in Texas. People would buy a building in 2019 and 18 months later sell it for 40% more than they bought. And that's not real life. I don't think it'll happen again in my lifetime. So I think hopefully investors will come back to the approach of real estate being a long-term game plan. And if you approach it that way, you're going to win.
Yeah, exactly.
Yeah.
So you are looking for ways to keep that property for as long as you can. And when you decide that it's a good time to sell, then you have the option to do so versus just, essentially trying to luck out on some type of, almost lottery like, scenario in the market where you're flipping it for a lot more than you got the property for because that, a lot of that is not in your control, right? It's not up to you. And if something does go wrong, you could be really, in a really bad position and you don't want to do that. So
Yeah, you don't want to be the last one in a game of duck, duck, goose, where you're going around and you can't have a chair. And human nature is such, people get uh jazzed up, and it happened in the single family market, happens in the most, they get jazzed up, they see prices going up, and they want a piece and they want a profit, and maybe a little bit of rationality goes out. So it's kind of, things are never as bad as one thinks, and things are probably never as good as one thinks. And for me, even though I'm still buying multifamily, and I understand values may continue to drop a little bit here in the next year or so. But for me, I don't really care. If I can get a good quality property in a good location and I can make the numbers work today, I want to buy it because I want to own that asset because I know 7 years from now I'll be happy I own it, even though it may drop a little bit. Now, some people may think they can time the market and buy at the absolute bottom and sell at the absolute top. I don't know. I've been doing it for 46 years. I don't think I can time the market. Uh, Maybe some people are smarter than me, but I'd submit the top and bottom of the market's only known 12 months after the fact. And based on my experience, when a market turns, it turns quickly. And if you're not kind of right there, so my sense is whenever the Fed starts dropping rates, and I'm not going to predict when it is, it may not be to 2025, may not be to 2026, who knows? But once they start dropping rates, I think you're really going to see kind of a real uptick in the real estate market, both for single family homes and multi, because people are waiting. And as soon as they get that signal, they're going to be jumping in. And if you're fortunate enough to jump in right at the right time, great. But just be ready to do so.
right,
Yeah.
exactly. Yeah. So the last question that I have for you, just kind of wrap up the show here, is really specifically for our, our listeners or viewers who are agents and brokers who are actively in the real estate, brokerage space. So that's how you started out in real estate as well as on the brokerage side. So what advice would you have for agents and brokers that are out there who want to build wealth through real estate investing? Should they be working with investors? Should they be, considering opening their own brokerage? What was the path that you kind of followed, and what advice would you give to agents and brokers in the market today to, actually build wealth in real estate instead of just be that salesperson forever?
Yes, yeah, great question. So a couple things, and let me start with maybe a number one thing, real estate professional status. Uh, so if you qualify as a real estate professional per the IRS code, and there are some detailed rules, and consult your tax advisor, CPA. But if you are a real estate professional, uh, the tax code provides you some great advantages. And basically, what it allows a real estate professional to do is offset any of the paper losses generated by real estate through depreciation. Use those paper depreciation losses to offset your commission income, where with other individuals who make over 150,000 a year adjusted gross income, you can't write off that. It gets to be a loss carry forward. So number one, I'd encourage agents to investigate real estate professional status and see how that could be used to reduce their tax liability. In some ways, that's the keys to the kingdom for agents and brokers. Number two, start investing yourself. Um, and uh, you can invest in your local market where your market knowledge is your competitive advantage. And I'm a big believer in local knowledge. The only place I buy apartments is in Greenville, South Carolina. We know this market. As we all know, uh, real estate changes street by street, block by block, neighborhood by neighborhood. And to the degree you know your market intimately, that's your advantage. So encourage you to maybe start looking to invest in your own market. And in some markets, maybe it's not the greatest. High price metros might not be the best place to invest in single family homes. You then might consider passive investing in syndications elsewhere in the country. So I have a lot of former colleagues in the Bay Area that invest in Sunbelt real estate. They love living in California, but they understand investing in Texas and South Carolina, North Carolina, Florida is better for them. And all those passive losses, if you are a real estate professional, apply. So whether you invest in syndication or individual ownership, you have those advantages. Number three would be, if you want to increase your brokerage business, start working with investors, right? I mean, uh, generally you're trying to find Joe and Sally a house for their family, and that's great. But maybe Joe and Sally want to start buying some rental property. So I think as you educate yourself about investing and can talk to your clients about the benefits of real estate investing, you create another source of activity for your brokerage business. That's a way where maybe you could increase your sales volume 10, 20% by just adding a few rental brokerage sales to your annual input. So I think that would be it. Investigate reps, start working with investors, and start investing for yourself, because uh, I was a real estate broker for 35 years, and we all got those calls at 10 a.m. on a Saturday morning where a client wants to go look at a house, and you got a son's little league game or your daughter's dance recital, and now you're, well, do I take care of the client? And that's so through real estate investing, you can create a little bit more time freedom. And eventually, what I would say, you could transition the brokerage income into real estate investments that then create passive income that could match what your commission income is. Now, you still need to manage your real estate investments, but I would say it's a far less hectic, strenuous situation than working with 5 or 6 buyers and sellers at the same time, 8 p.m. phone calls, Sunday afternoon open houses. So I did it for a long time. And now that I'm more in the investing world, I like having a little bit slower pace of life.
Yep,
Yeah.
exactly. So it's going
Yeah.
from the transactional income mindset to the passive income mindset because when you do, right, when you sell a house, it's not going to keep paying you. It's going to pay you once. It's going to pay you once well, but it's not going to keep paying you. But if you buy a rental property, it will do that and it'll also have appreciation over time, like we talked about, the longer that you own it. So
Yeah, that's a great way to look at it. Get rid of the transactional income to create more long-term, steady, passive income. Makes sense to me. Yeah.
absolutely. Well, Arn, man, I appreciate you for being here today. You shared a ton of value with us and a lot of your experience as well. And I really appreciate that. I think our viewers and our listeners are going to get a lot of value from this that they can apply to their business, right, on the investing side and on the brokerage side as agents and brokers as well. So for anybody out there who who want to learn more about what you do, who want to maybe even invest with you in one of your syndications as a passive investor, or just want to kind of follow along your continued journey in investing in real estate, what are some of the best places for people to find you or to follow you so that they can, or even get in touch with you directly?
Well, thanks, Kobe. And first, let me say, I can tell by your questions you understand this business, and so I think you have a good sense of where you want to go and how to help other people get there too. So, enjoyed the conversation. I'm very active on social media, Facebook, LinkedIn, either under Arn Senadella or Spark Investment Group. Website is investwithspark.com. So easy to find, reach out. The other thing I'll mention is I am starting a coaching program for folks who want to get into multifamily investing. So I'm excited about that. It'll be a relatively small group. Want to find, 5 to 10 really motivated people who either want to start multifamily investing or maybe, as you indicate, transition out of single family to multifamily. Maybe something I should have done 20 years ago, but you do what you can when you can. So happy to talk real estate and look forward to continuing the conversation.
Awesome. We'll make sure
Yeah.
to leave the links to that in the description, the show notes down below, so that way it's easy for you to find. But other than that, man, thank you again for being here and sharing your knowledge. Before we let you go, is there any last pieces of advice, any last tips you would like to leave with us here?
Uh, no, just buy real estate. They're not making any more of it. How's that? It's pretty simple. I borrowed somebody's quote. I forget who it was from.
It's
Yeah.
good advice, so that's all
All
that
right.
matters.
All right, Kobe. Thanks. Have a great time. A great day. Yep.
You as well. Appreciate it. Thank you for
Yeah.
tuning in, and we'll see you on the next show. Take care.